Welcome to Business Talk here on businesstech.co.za. I'm your host, Michael Avery, and today we're turning our attention to a critical issue that touches on infrastructure, climate resilience, and the future of investment in Africa. Joining me is Mpho Mokwele, who's the head of project finance at the Development Bank of Southern Africa, or the DBSA as we know it. Mpho is certainly no stranger to the world of high-stakes project finance with an impressive track record, including spearheading over 60 infrastructure projects, 35 of which are in renewable energy. He's recently returned from COP29, where he served as the DBSA's delegation lead and participated in some pivotal panel discussions about Africa's climate finance challenges and opportunities. And today we're going to unpack what those conversations mean for the continent and how mechanisms like risk sharing can help bridge the investment gap. Paul, great to have you with us today. Welcome to the show. You recently served, as I said, as the delegation lead for the DBSA at COP29. Why was it important for Africa to have a strong voice at this year's conference?
Thanks, Michael, and thanks for having me. I must say, someone has taken my position. And see, you still have a head of project finance. I've now recently moved to group executive of the transacting division. So, so sort of a big sort of job that I have ahead of me in order to try to scale up, especially the work that we're doing around the just transition. So it's quite a lot of a lot of work that I've got ahead of me. We've funded a lot of renewable energy projects as the DBSA. We've funded a program called the Embedded Generation Investment Program. So we took some of those lessons learned under the Renewable IPP program as the DBSA, having spearheaded that program for a number of years, for the past 14 years, to COP29 as me playing the lead from a DBSA perspective, because I've been quite involved in the renewable energy space for the longest time. So it was quite important that we are well represented, coming back to your question, as the DBSA as South Africa, in terms of some of the lessons that we've learned in terms of the work that we've been embarking on for the better part of the last 10 years and plus from a DBSA point of view. But most importantly, how then do we scale up in the next 10 years or so, especially leading up to net zero 2035 and then up to 2050. So it was about scaling up. It was most importantly me being a banker, a lender. How then do we raise climate finance, which is quite important in order to be able to achieve the just transition? So being quite involved at COP29 on a number of panels talking about how do we bring in the private sector, how do we bring in institutional investors in order to scale up some of the work around the just transition. So it was quite important for me then to be involved in a lot of those discussions with multilateral development banks, with DFIs, and as well as a number of institutional investors, such as the likes of All Mutual, which were quite involved in a number of panels, especially at what they call the South African Pavilion, where we had a number of panels been held at the South African Pavilion.
And I want to come to that idea of how we attract private capital, how we crowd it in, certainly as a DFI, as a key DFI. And I know Mark Swilling as well has been extremely instrumental in driving the focus through the organization. It's critical that every role player, not just government, not just the private sector, not just the DFIs or the banks, all the impact funds, they all come together. It's an ecosystem. But how did you firstly see the tone or the focus at COP29 differ versus previous COPs, especially for emerging markets?
Look, I think there was a quite strong emphasis on climate finance, as I've mentioned, in terms of the affordability of climate finance. That was the key topic of discussion, because, a lot of the developing countries, as much as previous COP conferences, concentrated on pledges in terms of, climate finance, there was a lot of discussion now at this COP about raising affordable concessional finance instead of just finance overall, which is not affordable for these developing economies. So there was a lot of concentration on that in terms of grant funding, in terms of concessionary finance this time around, in order to ensure that developing economies are not debt burdened after all if they tap into that funding. If you look at the climate, or rather the just transition funding package that the South Africa was able to secure at the previous COP, ultimately, when we looked at the underlying terms and conditions, we then found out that is actually not affordable, and it might actually lead to us being debt burdened. So we had to look at the fine print in order to ensure that if we do access that type of funding, it's actually not going to lead us into a rabbit hole ultimately. So a lot of concentration on ironing out whether the finance that's raised this time around, or at least that's pledged this time around, is affordable for the developing economies and emerging economies, just to make sure that ultimately it's actually fair from a terms and conditions point of view.
Yeah, and I know on that jet IP, it's now up to 13.8 billion US dollars, of which only half a billion is what you would call really concessional finance. So 4%, which is really not what this is about, especially given the historic emissions development pattern that has been enjoyed by the developed world, now asking the developing world to pay for the transition while not having had the same benefits. And so that really is what this boils down to. On your first panel, you discussed attracting private capital into Africa's climate finance landscape. What do you see as the biggest hurdles that Africa faces in doing so?
Sure. Yeah, I mean, that was the topic of discussion, the key topic of discussion, because a lot of the climate finance is concentrated in the developed economies, if you look at it. So they're the ones benefiting from it. Although, to your point, they're the largest emitters globally. So the panel concentrated on what are those challenges or hurdles that are inhibiting the developing countries and emerging economies from securing this affordable climate finance. And some of the challenges, Michael, were one, the risk perception in terms of, the perception of risk on the continent, especially on the African continent, where this general sense of this high risk on the continent. But if you look at it, one of the things I mentioned on the panel, if you look at the trends in terms of infrastructure performance, or infrastructure investment performance on the continent, the default ratios are quite low, such that investors should actually be comfortable investing on the continent. So there's that aspect. The second aspect was around currency mismatches. If you look at some of these just transition finance that's been pledged, that's been raised from the likes of the Green Climate Fund, um, it's in hard currency. So the issues then center around, is that on its own not going to burden, before you even get to the levels of interest rates, on its own, the fact that you are not lending or providing this finance in local currency, is that on its own not going to burden the developing economies? So that was highly debated as well. That currency mismatch issue, the fact that underpinning these economies is, the revenues are generated in local currency, but the finance is in hard currency. So that was debated extensively. But most importantly, we discussed the aspects around project preparation, because all this finance has to go into projects that are ready, that are bankable, renewable energy projects, be it new energy vehicles. So we debated quite a lot about how do we ensure that these economies are able to tap into this finance, against bankable type of projects that are sustainable on their own on a standalone basis. So we discussed the aspects around multilateral development banks, DFIs such as ourselves, coming in and then providing project preparation facilities, technical assistance in order to ensure that we do actually tap into this type of climate finance.
I think it's so important to understand that, the currency mismatch as well. There's a structural depreciation in markets with higher rates of inflation versus those that have lower rates of inflation, mostly in the developed world versus the developing world. So these are very important issues that need to be ironed out. To build on what you said as the DBSA's role as well, were there any standout solutions or innovative ideas from the panel that you believe can be implemented in the short term? Because the challenge is urgent.
And I alluded to it. We play quite an important role when it comes to project preparation. We've got a whole division within the DVSA that concentrates on that because we've come to the realization that there is no shortage of funding globally, let alone in South Africa, where we've got deep capital markets. The issue is, are there enough projects that are bankable, that are viable for investors to invest in? So that was one of the key standard points. We, as well as trying to find the solution around local currency lending as well, that stood out. But most importantly, a lot of the countries or sovereigns on the continent, including South Africa now, um, have fiscal constraints when it comes to attracting finance or providing sovereign, what we call sovereign guarantees. The Renewable IPP program was successful because the South African government at the time had fiscal space in terms of providing government guarantees to investors that unlocked a lot of capital to the tune of about 254 billion, and that's why that program was successful. We are now trying to embark on another program which is quite important as well in terms of unlocking additional renewable energy capacity onto renewable energy capacity to be connected to the grid. The challenge is transmission, which is becoming quite topical, not only for South Africa, but globally as well, where we've got grid capacity constraints. We are not able to deploy additional renewable energy capacity. So the question is, then how does the South African government come to the party in attracting institutional investors to come in, global investors to come in and invest in transmission? So we are now talking about credit enhancement mechanisms that sit outside of government. There's the talk of the credit guarantee vehicle that the likes of the World Bank are developing for the transmission program, and for that matter, for infrastructure projects and programs that are going to come up without the South African government necessarily providing those sovereign guarantees. So we are now thinking of innovative type of credit enhancement mechanisms to unlock infrastructure independent from various governments. And that talks to the likes of the DBSA, multilateral development banks, coming to the party, providing what we call first loss facilities and other forms of guarantees in order to then catalyze institutional investors that are sitting on lots of money in order to come in and invest in infrastructure, including transmission.
Such an important point, that, but also the regulatory reforms that we've seen with the unbundling of Eskom, now having a separate national transmission company with its own kind of balance sheet, able to go out and raise capital. We saw just this week how Eskom announced some preferred bidders in terms of providing services to the national transmission company as it looks to ramp up its rollout of transmission and grid infrastructure. Coming back to that, kind of almost first loss absorbing role that you play, how does the DBSA balance its dual mandate of financial sustainability and developmental impact when tackling these challenges? Because you've got to be sustainable and self-funding in your own right.
Look, we do it quite well, I must say. We if you look at Michael, it's not difficult. I think you find opportunities where there's development needs all the time. And I always say to people that DBSA has been looking at, that dual role of financial sustainability and development impact for the longest time. And it's in our name as well. And you look at a lot of the private equity funds, including institutional investors, they talk about it like they call it, impact investing. But we've been at it for the longest time. So the two are not mutually exclusive. You can do both seamlessly, at the same time. So it does not necessarily mean if you are investing in high impact projects, you have to forgo financial sustainability. So we are able to achieve the balance seamlessly. We of course have to at the same time invest in projects that offer us more commercial returns now and then, in order to just balance out the developmental aspects of investing on our side. We of course then have to do a lots of work in terms of attracting lines of credit that are concessional in nature from various investors, including multilateral development banks. And that was one of the panels I was involved in order to make sure that when we invest, we are able to provide concessional finance, but without necessarily impacting on our financial sustainability. So our treasury team does quite a lot of work in that regard in terms of raising those concessional lines of credit.
Yeah, and your second panel was focusing on exactly that, on risk sharing mechanisms. Given the staggering, I mean, it's between $3 and $6 trillion financing gap. I think sometimes we bandy these numbers about and we don't quite grasp just how large these numbers are. I mean, that's what we need by 2050. How do you see instruments like blended finance or guarantees playing a role in achieving that sort of scale?
Very important in terms of unlocking, especially institutional investors. I mean, you look at a lot of institutional investors that are in South Africa, in the South African market. They are sitting on a lot of cash. Although it has opened up that they can invest in infrastructure, most of them are still a bit weary about investing in this asset class. So it's our role in terms of providing those guarantee instruments that you're talking about and other risk sharing mechanisms that we, in order to unlock that big pools of capital. We understand the infrastructure game, but a lot of these institutional investors are quite weary about investing in this asset class. So our role is to bring them along the journey and say, look at the DVSA. We've been successful in investing in infrastructure. Look at the successes of the Renewable IPP program. Let's now embark on on the transmission infrastructure program journey together. Take some of the lessons that we've learned under that program, and then some of the things that did not work so well, try to fix some of those types of issues. And you've already started touching on some of those things that did not work so well. And we are, if you look at the transmission program, which the DVSA is trying to work on, um, we are trying to correct some of those things that did not work so well. And some of those things is around industrialization. How do we piggy bank or leverage the transmission program that we want to embark on in order to stimulate economic growth, in order to create jobs in the process? And you saw what you were talking about, that NTCSA, the transmission company, about a day or so ago, they've signed a number of EPC contractors, construction companies, and as well as component manufacturers in South Africa. That talks to the industrialization component of the infrastructure programs and how we should do things going forward. The local content aspects of those programs are essential in order for us to create a lot of jobs in the process of implementing those infrastructure programs. So we are trying to support the industrialization part of those programs. So you've got the investment side of the program, which is the transmission investment program, which we are trying to work on, trying to set up a similar type of an office as the IPP office, which was quite instrumental in implementing the Renewable IPP program. We are trying to set up a similar type of office with the National Transmission Company of South Africa in order to unlock private sector investment in that space. But equally important is the localization component of it, which we call the industrialization program, tied with the transmission program. How do you increase local capacity when it comes to skills capacity, when it comes to construction capacity and manufacturing capacity? So we want to work on those components well before the transmission investment program is then implemented. Equally important, because we know we are struggling when it comes to job creation in this country.
Yeah. Yeah. And so you can then ensure that you've got the capacity to fulfill that pipeline of demand as it starts to get filled. And from an investment perspective, I chat to CISA, they've got between 5 and 6 trillion rands in assets under management, most of it at an institutional level, retirement fund money. And so that's, it's long dated liabilities. They're very well matched to infrastructure, which have predictable, long dated cash flows as well. And so, the two seem very well matched, but it is about providing a bit more education around investing in the asset class, I guess, and dealing with maybe concerns or questions that investors might have around liquidity. I guess the other concern might be just with the rollout of these large scale infrastructure projects, how we engage communities to ensure that we can get ahead of some of the construction mafia and extortion type tactics that we have seen in projects where there hasn't been proactive engagement with the community ahead of time. And so it was very encouraging to see the Durban Declaration recently, where you've got government, you've got the private sector working together to say, right, how do we do this in a way that can certainly blight out any criminality? But I just want to come back to COP29. What were some of the other interesting talking points and resolutions for COP29 that you think could have a significant impact on South Africa?
I think the key one is the fact that about 300 billion US dollars per annum has been pledged, and we are looking at scaling up that sort of climate finance package to about 1.3 trillion US dollars per annum post 2035. And multilateral development banks, including ourselves as a DFI, are quite important in terms of unlocking that level of finance going forward. So that was quite important. And I think the other aspect I touched on is the proportions in terms of concessionality of that finance and vis-a-vis finance that is perhaps maybe not that affordable. So the proportion between grant funding, concessional finance, and maybe market related finance was discussed at quite a lot of length in terms of those proportions. And it's quite important that for developing countries, the proportion is more towards grant funding and concessional finance in order to ensure affordability. So I found that discussion quite important after a lot of negotiations behind closed doors, so that the same mistakes are not repeated compared to the previous COP conferences.
Well, it's very encouraging to go into the next COP, which is going to be in Amazon with Brazil, one of our key BRICS partners, to see that the emerging market voice is being taken so seriously at the global table. I think we can only hope but to build on these gains as we develop into the next COP in Brazil. Thanks so much, and for invaluable insights, and clear that the DBSA is not just financing projects, but through your project preparation efforts, also driving meaningful change for Africa's sustainable future. We'll be watching closely as these COP29 outcomes take shape. And to our listeners, stay tuned for more thought-provoking interviews right here on Business Talk.
Thank you, Michael.